Hey everyone, welcome back to Corporate Decoder, the place where we dig into the financial reports of companies. Today, we're looking at Tanger Inc., a company that owns and operates outlet shopping centers and open-air retail spaces. It's a bit like going shopping on Black Friday, except we're decoding the financial statements. I hope it's more exciting than camping out for deals. Let's see what's going on with their money. Tanger had a pretty good year, buying some new properties and making some changes in their leadership. Let's get right to it. First off, Tanger made a big purchase in December, snagging a 270,000 square foot open-air shopping center in Little Rock, Arkansas. They paid $73.1 million for it. And it didn't stop there. Just recently, in February, they bought an even bigger property in Cleveland, Ohio for $167 million. This one's a 640,000 square foot mixed-use center, meaning it has stores, restaurants, and entertainment all in one place. To help pay for these purchases and other things, Tanger sold some of its own stock. During the year, they sold $115.9 million worth of stock at an average price of $34.34 per share. The company also made some smart moves with its credit lines. They increased the borrowing capacity on their credit lines and extended the maturity date, giving them more flexibility and breathing room. Plus, they reduced the interest rate they have to pay. There have been some leadership changes. Stephen Tanger, who was the executive chair, retired from that role. The board also added a new member, Sonia Single. So how does Tanger make money? Well, primarily from rent. They lease out space in their shopping centers to various brands and retailers. A portion of their income comes from tenant sales. If tenants make more, the center also makes more, and some tenants are allowed to pay less if a center's occupancy declines. Each of their centers, except for one joint venture, has the Tanger name on it. They believe people trust the Tanger brand to deliver value and experience. Tanger is diversified between many tenants. No single one accounts for more than 8% of the space at the properties or 6% of the rental income. They also invest a lot in marketing to bring shoppers to their centers, including online and seasonal events. To get money, they may sell or lease parts of their existing properties and possibly sell properties that they think don't fit their long-term plans. Tanger faces competition from other outlet centers, traditional shopping malls, online retailers, and basically anyone else trying to get consumers' money. To protect themselves, Tanger carries insurance on their properties, including liability and damage insurance. However, some types of losses, like those from wars, may not be insurable. The company stresses things such as strong communities and making ethical choices. As of the end of the year, Tanger has 372 full-time employees and 53 part-time employees. As a real estate company, they're subject to lots of rules and regulations from different government agencies. Now let's talk about risk. Every company has them, and Tanger is no exception. Real estate values can be affected by all sorts of things, like changes in the economy, interest rates, and even government regulations. Development projects may have problems, such as unexpected costs or delays from construction and material shortages. Real estate can be hard to sell quickly. If Tanger needs cash fast, it might not be easy to sell a property at a good price. The value of Tanger's properties can go down. If this happens, they may have to write down the value of those assets, which would hurt their financial results. They're also dependent on the success of their tenants. If a major tenant goes bankrupt or closes stores, it could hurt Tanger's income. If they don't maintain high occupancy, tenants might be able to pay less rent, which would lower Tanger's revenue. Inflation could also be a problem, increasing costs for materials, labor, and other things. Some of their properties are owned with other partners, which can lead to disagreements or conflicting interests. Climate change and severe weather could damage properties or make it harder for people to shop at their centers. If a major disaster hits one of their properties and they don't have enough insurance, it could cost them a lot of money. Having properties in Canada also comes with its own set of problems, like changes in the exchange rate between the US and Canadian dollar. They might not be able to borrow money or issue stock on good terms, which could hurt their ability to grow. They guarantee debt for some of their joint venture properties. If those ventures can't pay their debts, Tanger could be on the hook. Adverse changes in the company's credit ratings could also increase interest expenses. Their hedging strategies to protect against interest rate changes might not work, which could cost them money. The price of Tanger's stock can go up and down a lot, which can be stressful for investors. As a REIT, they have to meet certain requirements to avoid paying corporate income tax. If they failed to qualify as a REIT, it would be very costly. New tax laws could also hurt their business. The REIT rules might force them to miss out on good investment opportunities. Cyber attacks or acts of cyber terrorism could disrupt their business and expose sensitive data. Increased focus on ESG could also increase costs and expose them to new risks. Their success depends on having talented employees, and if they can't attract and keep those people, it could hurt the company. The use of artificial intelligence presents risks and challenges that could impact the company's business. Tanger's CEO and CFO have looked at the company's controls and procedures and believe that they are effective for accurate and timely financial reporting. The Senior Vice President of Technology helps to identify risks. The company uses a well-defined plan if and when a cybersecurity incident happens. Thankfully, as of the date of the report, no cyber attacks. As of the end of the year, Tanger had 33 consolidated centers. They also have interests in 6 other outlet centers. The company keeps acquiring properties, such as the recent acquisition in Ohio. The tenant leases range from 5 to 10 years. The occupancy at the end of 2024 was 98%. 19% of the portfolio's leases come up for renewal this year. Tanger is sometimes involved in legal stuff, but the company believes that nothing significant is going to affect their financials. The main way that Tanger makes money is through its operating partnership. They can also issue more stock to get capital when necessary. They want to have the ability to borrow and use additional capital as needed. The company depends on distributions from the operating partnership to meet its financial obligations. Tanger has an at-the-market stock offering program, which means they can sell shares over time. The company also entered agreements to sell common shares under the ATM offering. The company has a plan to repurchase up to $100 million of their own stock through May of next year. The board declared a cash dividend of $0 and 275 cents per share in January. The company says substantial inflationary pressures can negatively affect them. The Enterprise Risk Management Group determines the top risks to the company and what to do if any arise. The cybersecurity and operations of the company are continually monitored by executives and the SVP Technology in order to safeguard against various technology risks and vulnerabilities. The company might face additional costs with a new focus on environmental, social, and government-esque factors. The success of the company is impacted by their executive team and key employees. Use of artificial intelligence presents risks and challenges that could impact the business. As for the company's financial statements, they are included in full here for you or any investor to make their own informed decision. Okay, so what do we make of all of this? Overall, Tanger seems to be heading in a positive direction. They're expanding their portfolio with new acquisitions, which is a sign of growth. However, they need to be careful to balance growth with managing risks. Some areas to watch include the risks related to relying on tenants, inflation, the state of the credit markets, and the need to maintain their REIT status. Based on their current performance and future opportunities, a reasonable target price range for Tanger's stock might be around $35–$40. They seem to be managing things well. With all this said, I'm leaning toward a bullish outlook, with the understanding that potential investors should do their own research and consider their individual risk tolerances. If you found this decoder ring helpful, please like, subscribe, and hit the notification button for more decoded corporate financial statements coming soon.